Imagine this. It's Friday afternoon, December 26th, 2025, and the markets are winding down for the holiday weekend. You're scrolling through your feed, maybe checking your retirement account or that side hustle in silver ETFs you've been nursing since the summer rally kicked off. Suddenly, alerts ping like fireworks. Silver futures spiked 12% in after-hours trading, blasting past $80 an ounce for the first time ever, touching $82 in a frenzy that feels more like a glitch than reality. Whispers turn to shouts. Is this the decoupling we've all been waiting for? Or the spark that lights the fuse on everything from your 401k to the mortgage payments stacking up in Toronto or Seattle? Markets are closed until Monday, but the world's already unraveling in chat rooms and family group texts. What happens when the bell rings again? Will silver hold its ground, or will it drag the whole financial house of cards down with it? Buckle up, because this isn't just a blip. It's an echo from history, a warning wrapped in shiny metal, and it could rewrite the rules for every saver, investor, and debtor from Vancouver to Miami. Welcome to Cash Historian, where we dig into the buried truths of money's wild ride. Those moments when greed, power, and plain bad luck collide to expose the cracks in the system we all rely on. I'm your host, and today we're cracking open the $82 silver shock, peeling back the layers of what drove this metal to madness 4 decades ago, and why it's staring us down again right now. With global debts ballooning to $324 trillion and central banks like the Fed and Bank of Canada tiptoeing around rate cuts that feel more like desperate prayers. Stick with me, because by the end, you'll see why that Monday morning open isn't just about silver. It's about whether the economic paradoxes we've been living with, from endless money printing to housing bubbles that won't burst, are finally catching up. And trust me, the twists here aren't in some thriller novel. They're etched in ledgers and headlines that shaped fortunes and shattered them. Let's rewind, not to last week, but to the late 1970s, a time when America was grappling with its own version of today's chaos. Inflation was a monster, gnawing at paychecks like it is for so many families right now, with grocery bills up 25% since 2020 and Social Security checks barely keeping pace. Oil shocks from the Middle East had gas lines snaking around blocks in Detroit and Dallas, much like the supply chain snarls that jacked up prices during the pandemic hangover. And in the shadows of Wall Street, 2 Texas oil tycoons, Nelson Bunker Hunt and William Herbert Hunt, the brothers Hunt, were plotting something that would make even the boldest crypto whales today blush. These weren't your average speculators. They were heirs to a wildcatting empire, the kind of men who saw oil gushers in their dreams and built fortunes on black gold. But by 1973, with Arab embargoes flipping the energy world upside down, the Hunts turned their gaze to another commodity whispered about in survivalist circles: silver. Why silver? It wasn't just bling for the rich. It was the people's metal, used in everything from photographic film to electronics, and a hedge against the dollar's freefall. The brothers, devout and deep-pocketed, started buying in earnest, convinced the greenback was doomed under President Carter's watch. Cause and effect, right? Rampant inflation, eroding trust in paper money. Sound familiar? Fast forward to 1974, and the Hunts had already scooped up 1/3 of the world's freely traded silver, driving the price from $4 an ounce to over $11 in a blink. But they didn't stop there. No, they got clever, borrowing against their oil wealth to buy futures contracts, promises to buy silver at today's price tomorrow, leveraging up like a house of cards in a windstorm. By 1979, with the Iranian Revolution sending shockwaves through global markets, silver was their obsession. They weren't just accumulating, they were cornering the market, controlling supply to squeeze prices higher. Here's where the mystery thickens, and I don't mean the kind you solve with a detective's magnifying glass. The Hunts weren't alone in this game. Whispers from the trading floors pointed to Saudi royals and even European banks quietly joining the fray, all betting on silver as the anti-dollar fortress. Was it a coordinated play against a weakening America, or just opportunistic wolves circling the same wounded prey? We'll circle back to that, because the real intrigue isn't in who held hands. It's in how this all snowballed into a force that Wall Street couldn't ignore. Picture this. By early 1980, the Hunts owned not 30% of available silver, but upwards of 200 million ounces, half the world's annual production, stored in vaults from London to Zurich. Prices, they quadrupled in 6 months, rocketing from $6 to $50 an ounce by January. That's not a market. That's a mania. Investors from coast to coast piled in, from Midwestern farmers hedging against feed costs to Hollywood stars flashing silver jewelry like it was the new status symbol. But every rise has its roots in the rot beneath, and the cause here was a perfect storm of deregulation and desperation. Remember, this was pre-Volcker era. The Federal Reserve, under Chairman G. William Miller, was pumping liquidity like it was going out of style, keeping rates low to support the economy, but fueling the inflation fire instead. Sound like the post-2008 quantitative easing marathon we've been running? Or the Fed's balance sheet ballooning to $9 trillion by 2022, only to hover around $7.5 trillion today amid whispers of another round of cuts. The Hunts exploited that lax oversight, using unregulated foreign exchanges to amass positions that dwarfed what domestic rules allowed. And as silver soared, so did the brothers' paper empire, valued at $10 billion at its peak, enough to buy entire cities. Yet, buried in those gains was the paradox. Leverage is a double-edged sword. Every dollar borrowed amplified their wins, but one wrong gust, and it all flips to losses faster than you can say margin call. Now, let's lean into the chronology, because history doesn't whisper, it roars when you trace the threads. January 1980. Silver hits $50, a level that makes today's $82 spike look tame by raw numbers, but eerily similar in velocity. The Hunts, emboldened, announce plans to take delivery on their futures. Not just speculate, but physically claim the metal, starving the market of liquidity. Panicked shorts, traders betting on a fall, start covering positions, buying back contracts and driving prices even higher. By mid-February, exchanges like COMEX in New York are overwhelmed. Trading halts multiple times as lines form outside brokerages, folks clamoring to get in on the ground floor. The media frenzy, nonstop. Time magazine dubs it the Great Silver Rush, with cartoons of the Hunts as modern-day King Midas, turning everything to gleaming white. But beneath the glamour, cracks were forming. Central banks, sensing a threat to the dollar's supremacy, began intervening quietly. Rumors swirled of the Fed jawboning big banks to unwind exposures. And the commodity regulators? They were asleep at the wheel until it was too late. Fast forward to Silver Thursday, March 27, 1980, the breaking point that still sends shivers through veteran traders. It started innocently enough. The Hunts, overextended and facing demands for more collateral, tried one last gambit, borrowing $1.1 billion from international lenders, secured against their silver hoard, to roll over expiring contracts. But the night before, the rules changed. COMEX, under pressure from Washington, hiked margin requirements threefold overnight. No warning, just a midnight edict. Cause, effect. The brothers couldn't meet the calls. Their liquidity dried up like a Texas dust bowl. When markets opened, silver plunged 50% in hours, from $21 to under $11, wiping out $4 billion in value, more than the GDP of some states back then. Brokers collapsed. Suicides were whispered about in the aftermath. The Hunts, bankrupt on paper, their empire seized in a fire sale that flooded the market with silver, crashing prices to $4.80 by year's end. The fallout? It rippled like a stone in a pond, but deeper and darker. First, the human toll. Thousands of small investors, lured by the hype, lost life savings. Retirees in Florida condos, young families in Chicago bungalows betting their down payments. It eroded faith in markets, sparking congressional hearings that birthed stricter commodity rules, like position limits we still feel today in everything from oil to Bitcoin futures. But the real conspiracy thread, the one that keeps me up at night, is how the fix was in from the top. Paul Volcker, the new Fed chair, had jacked rates to 20% by then, crushing inflation, but also popping the silver bubble as collateral. Was it coincidence? or a deliberate squeeze on speculators threatening the system's core. Documents later revealed Treasury officials coordinating with exchanges, echoing the secretive Jekyll Island meetings of 1910 that birthed the Fed itself. And the Hunts? They clawed back via lawsuits, settling for millions, but the scars lingered. A reminder that in money's game, the house always wins. Failed fixes piled on the pain. The CFTC, the watchdog agency, promised reforms but delivered half measures, liquidation-only rules for big positions, meant to prevent corners but often just delaying the inevitable. Which brings us seamlessly to now, because history doesn't repeat, but it rhymes. And what markets are pricing in right now feels eerily familiar. Silver isn't just rising, it's behaving like a pressure valve, reacting to forces far bigger than supply and demand headlines. Analysts have begun whispering about levels once considered unthinkable, with recent trading spikes pushing silver into territory that would have sounded absurd just a few years ago. Not a prediction, an observation, a signal. Think about it. Just as the inflation beast of the 1970s clawed at everyday wallets, we're staring down what many economists now call a debt supernova. According to international finance estimates circulating in early 2025, global debt has surged past $300 trillion, an abstract number until you break it down to roughly $40,000 per person on Earth. In the United States alone, federal obligations hover in the mid-30 trillion range. Canada's public debt sits well above the trillion-dollar mark. These aren't fringe figures, they're the backdrop. Even long-term safety nets are under strain. The U.S. Social Security Trust Fund, according to its own actuarial outlooks, faces depletion in the mid-2030s under current assumptions, potentially sooner if economic growth underperforms or financing conditions tighten. That doesn't mean checks vanish overnight. It means promises start competing with reality. And then there's central banking, where the language is calm, but the signals are anything but. Recent policy shifts by the Federal Reserve have leaned noticeably more accommodative, with rate cuts framed as precautionary, even as inflation readings remain stubbornly above historical comfort zones. It's a familiar tune. Liquidity expands, confidence is projected, and the word transitory quietly re-enters the conversation. North of the border, the Bank of Canada walks the same tightrope, weighing housing fragility against slowing exports, cautious not to tip the balance too far in either direction. Cause leads to effect. Easy money hunts for scarcity. And scarcity doesn't live in spreadsheets, it lives in atoms. That's where silver re-enters the frame. Look at the rise chronologically. At the start of the year, silver prices felt stagnant, still shaking off the false starts of the previous cycle. Then industrial demand began to assert itself. Solar installations surged globally. Electric vehicles quietly increased their silver intensity per unit. The numbers vary by source, but the direction is consistent, and it echoes the photographic boom that once transformed silver's role decades ago. Layer geopolitics on top. Sanctions, regional conflicts, labor disruptions in major producing nations. Supply tightened not dramatically, but persistently. Meanwhile, retail enthusiasm surged again, online forums swelling with voices convinced they were watching history repeat. By late in the year, silver had challenged levels not seen since the early 2010s, then pushed beyond them as thin liquidity amplified every move. What followed wasn't a straight line. It was a cascade, driven as much by positioning as by psychology. And just like before, institutions and individuals weren't playing the same game. Internationally, official silver lending programs once served to stabilize markets under stress, temporary measures framed as liquidity support. In hindsight, they look like early prototypes of too-big-to-fail mechanics, years before that phrase entered the mainstream during the 2008 crisis. The paradox was striking. While silver absorbed the volatility gold, the metal of institutions, held its ground far more gracefully. That divide never closed, it sharpened. Everyday participants gravitated towards silver for its accessibility and industrial relevance. Institutions gravitated toward gold for one reason only: permanence. Fast forward to today, and that same split defines the market. Silver feeds solar grids and electric fleets. Gold feeds balance sheets and pension allocations. Different roles, different protections. So when silver begins to move aggressively again, it's not chaos, it's rhyme. Easy money chases hard assets, and silver has quietly moved to the center of that storm. Look at the rise chronologically, because this didn't happen overnight. Silver entered 2025 in the high 20s, still shaking off another false start from the year before. Then the pressure began to build. Industrial demand surged. Global solar installations accelerated sharply, and electric vehicles continued absorbing far more silver per unit than most people realize, echoing the kind of structural demand shock last seen during the photographic boom of the 1970s. Geopolitics added fuel. Sanctions on Russia, renewed tensions in the Middle East, and labor disruptions in key producers like Mexico and Peru tightened supply just as inventories were already thinning. Safe haven psychology crept back in, amplified by trade uncertainty and tariff rhetoric that felt uncomfortably familiar to anyone who remembers past inflation cycles. Retail participation followed, with online communities swelling and speculative enthusiasm rising in ways that mirrored earlier commodity manias. By late in the year, silver was no longer flirting with old resistance levels. It was pressing into territory most analysts once dismissed outright. Successive supply deficit reports, tightening physical markets, and aggressive positioning in Asian trading hours pushed prices toward levels that forced even skeptics to reassess their assumptions. What looked like a slow grind suddenly felt like a squeeze, not driven by hype alone, but by the cumulative weight of demand finally colliding with limited supply.